Morning, Mark Chameleons. How you doing this morning, Dima?
Good morning, Will. Good morning, everybody. Thanks for joining us. So today I kind of did some different, usually I make notes about what's for the agenda today. I kind of put it out there in the chat. So I wanted to talk about today, and this is a relatively new feature we're looking at because we're collecting fundamental data on all the stocks. And fundamental data, it's not very straightforward. There's a lot of nuances. So we're trying to clean the data. It's taken a while, but we're going to do an example. We're going to go over, let me see, Apple and Google as an example. We're going to compare the valuation versus growth. So we'll do that as an example. We're going to do a quick screen for bullish out of the money calls from the unusual option screener. And I also wanted to go over, since Bank of America and Goldman Sachs came out with earnings, we're going to take a look at their historical price action analysis post earnings. So what usually happens after they report earnings. So we're going to go over those three things. And really quickly before we do, Will, let's put up that disclaimer.
Awesome. You see what's behind me before we do that disclaimer, D?
American Stock Exchange. So if you guys don't, Will and I, we used to work right on that exchange. We went to that building every day, worked on the floor.
And then we went down to there every day after.
Yep.
After we entered the main doors, we went down to the floor.
That's how
it worked.
Brings back memories. I forgot even how it looks. Yeah, so strange to look at that. Yeah, that's how it used to. That's how options used to trade. American stock. It also had a stock exchange.
It's amazing.
Amazing. Yep. Everyone, keep in mind before we start, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers, and we're not telling you what to do. We're just sharing ideas. If you need professional help, call your registered investment advisor or call your broker. They should be able to help answer your questions and provide you with guidance. There's the disclaimer, everyone. And with that, we could get going. And along the way, Will, let me know if there's any questions. If you see anything, just let me know. I'm going to get started, share my screen. So before we get into for the things that we have on the agenda, let's take a quick look at the pre-market and see what's going on and what's moving in the pre-market hours. Then we're gonna go and try to hit those three things on the agenda. So here, these are stocks that are moving in the pre-market hours. Trading before the market opens, we got the most active stocks, the biggest percentage gainers, the biggest percentage decliners. Really quickly, I want to take a look at what's going on in the higher market cap stocks. So I'm going to use this filter here, market cap filter for market cap stocks that have a $20 billion market cap or higher. So let's take a look there. And up top, I see NIO, that's up 9.6%. And that's what electric cars, right, Will?
Yes.
NIO. DocuSign up 3.1%. Goldman Sachs, we'll talk about that. That's up 2.1% on earnings. So here we see on the list, 14 made the gainers list, 5 on the decliners list. So a little bit tilted more towards the gainers, but not much going on. So maybe that NIO up 9.6%. So that's a pretty significant move. Let me just go to the unfiltered list really quickly. See what pops up on top. I see small market cap stock MDRR up 95%. In a pre-market, 3.4 million shares trading hands. That's a $5 million market cap stock. Very low market cap. Looks like they maybe have some news, but that doesn't really look like news. Something about their preferred stock. IDXG, that's up 45% on 4.2 million shares. Also low market cap stock. Let's see, that one also looks like some news coming out there. Let's take a look at this one really quickly.
Surprise, it's a biotech.
Biotech stock. All right, let's take a look at that one really quickly as an example, and then we're going to move on unless you have specific questions on the pre-market hours. So IDXG, healthcare stock. This is where it's industry, diagnostics, and research. It closed at $2.98. We see a 52-week range, $2.57 to $11, so close to that 52-week low. In the pre-market hours right now, trading $4.39. That's up 47% from yesterday's close. The VWAP price in the pre-market, $4.83. We see this is the range in the pre-market hours, $3.45 to $5.37. It's traded 4.3 million shares in the pre-market compared to a 4 million float. So very significant amount of shares trading on a relative basis. This is what the pre-market chart looks like. So we see a pop here. There looks like some news here hitting the wires. I'm not going to get into the news. I'll let you interpret it, read it, and see if that move is justified. Let's take a really quick look from the historical gap perspective, what the stock tended to do after gapping up in the morning. So here we're taking the last 3 years, the 12 largest gap moves. So the 12 largest moves at the open from previous days close to the open. And we're looking at the 12 largest gap moves. Here are the dates of those moves. We have notes here if there's a press release on those dates that could have served as a catalyst for that move. So we see here is the actual percentage opening gap move. On average, it gapped up 11.1% with a high here I see of 20% on April 27th, 2020. So here, 47%, much higher than we've seen in the last 3 years. So way above even that high move of 20%. Let's take a look. Again, there's news on it. Take a look what the news is. If that move is justified, I'll leave that up to you. I'm just going to take a look at the price action analysis post gap. So this is what it tended to do after the opening. From the open to the high of the day, it looks like the average move from the open to the high was 8.8%. It looks like 25% over here. That opening price was the high of the day, and it tended to then drift lower. From the open to the low of the day, the average move was 10.1%, so a little bit more tilted towards the low than the high. And from the open to the close of the day, it tended to drift lower more often than higher. 75% of the time it finished lower, 25% of the time it finished higher, for an average loss of 2.5%. So really quickly, that's just an example of a price return distribution in, what's this stock? IDXG after a large open gap move in the last 3 years. So I'm going to close this really quickly. Unless you have specific questions, Will, on the pre-market, I'm going to move on just to be able to cover the stuff we have on the planned out for today.
Perfect.
Okay. Let's take a look at Bank of America. I have that queued up. So Bank of America and Goldman Sachs reported earnings today. So let's take a look at Bank of America first. So right now, Bank of America, that one is down 2.2%. Let me refresh my screen. For some reason, I'm losing my...
While you do that, welcome, chameleons. We have some new chameleons on today. Cheryl, hi. Asgar, good morning, everyone. Listen, put all your questions in the chat. If we don't get them, make sure you go to the forum and put them in the forum. They will get answered there. Thanks for joining, everyone. Remember, thumbs up are always appreciated by us on YouTube. And if you're not subscribed to the channel, it's a big deal to subscribe. So do yourself a favor and do that. Dima, you find what you're looking for?
Yep.
Perfect.
So right now, Bank of America reported earnings today before the market opens. Right now, it's indicating in the pre-market hours down 2.2%. I'm going to take a look at its historical patterns, what it tended to do after reporting earnings. So this is looking at Bank of America, what it tended to do day of the earnings. So it looks here at the opening on the gap. Historically, 55% of the time it was higher, 45% of the time it was lower, for an average loss of negative 0.4%. It looks like the move up or down. So this is in absolute terms. It moved up or down 2.3% at the open. So let's just compare that, which is pretty close to what it's doing today, down 2.2%, which is kind of in line with what it usually does at the opening. From the opening to the high, the average move after it opens, the average move was up 1.7%. From the open to the low, the average move was down negative 1.2%. It looks like it finished from the opening price. So not on the day, from the opening price, it finished higher a little more often than lower. 64% of the time it was higher, 36% of the time it was lower, for an average gain of 0.5%. It looks like post earnings, the day after, 2 days after, 3 days after, it had some more strength. So 82% of the time, day after, the stock was up for an average gain of 0.2%. 2 days after, 82% of the time it was higher for an average gain of 1.2%. So you could see here that it tended to do better post earnings, coming out of earnings than actually the day of earnings. Let's take a look at Goldman Sachs. That one reported earnings as well. So also take a look at its historical behavior after reporting earnings. So right now, that reported earnings when last night. Did that report earnings? Well,
I'm sorry, which stock I was
reported earnings, right? So I think Goldman Sachs reported. Right?
All that banks are reporting this week. I think BAC, Goldman Sachs, JP Morgan have already reported.
So here we go. So that's up 2% today in the pre-market hours. Let me just see. Let me just make sure that, because I didn't actually. Wait, did it report her? I'm not seeing the press release for it.
Well, Jake is talking about it. I know they were talking about it this morning on CNBC.
Did it? How come I don't see a press release for it? Let me see it.
Jake, can you confirm whether it was reported or not?
I'm just going to go really quickly. I'm just going to go to their website. So I'm going to go to links. Let me just see investor, because usually I would see a press release, right?
No, we want to know if there's an issue. That's for sure.
Yeah. So I don't see. Oh, here it goes. Okay, it did report earnings. Reports third quarter earnings. Okay. So sorry about that. Let's just come back.
So everyone who saw that's as everything, we're processing data, right? Dima just walked through the steps all traders should look to confirm, what they're going to do. I mean, he showed all the links. I don't know if you want to show it again, but you can actually link to the company's website from our site, which is nice.
Right. So whenever you have a question, you want to see if the company issued something to investors, you could go to these links, investor relations company website. And what I did is just go and confirm that they did release earnings. And of course, one of the things as a trader, if you ever have questions about a website, about a company or what's going on, what they're doing, it's always good to go to the investor relations, even call them and ask them questions, right? About upcoming events, stuff like that. They would be able to help you if you're an investor in that company. They should be able to help you. So let's just come back to the earnings history, stock patterns over here. So up 2% today in the pre-market hours, reported earnings today. Let's take a look at the history. So this is what it tended to do historically at the open. 67% of the time gapped higher, 33% of the time it gapped lower for an average gain of 0.5%. It looks like that on average, up or down, the average opening gap move was 2.1%, which is like right in line with what it's doing today. Post open, so after the open, this is what it tended to do. From the open to the high of the day, the average move was 1.9%. From the open to the low of the day, the average move was down 2.3%. It looks like from the open to the close, it's really 50-50. Half the time it was up, half the time it was lower, for an average gain of for an unchanged, really. For on average, it was unchanged. So that's really quickly Goldman Sachs from a historical perspective. It does look like coming out the next day, 67% of the time it was higher on a 2-day hold, 75% of the time it was higher for average gain of 1%. So So still, more oftentimes it was stronger than weaker coming out of earnings. And, heading into earnings, it looks like that's where it was the strongest. So even prior to earnings, it looks like it tended to rally into the earnings. That's Goldman Sachs price action analysis. So let me see okay, unusual option. If you don't have any questions, I'm going to move, I'm going to try to move a little bit quicker. So I'm going to go to the unusual option volume.
Sounds good.
All right. So here, what I'm going to do is on this unusual option volume report, we're going to take a look at where there's activity in upside calls. So I'm going to look at, from notional perspective, where there's potentially a lot of upside calls being bought. Okay, so this is what we're going to do first. I'm going to look for implied volatility on a 30-day IV. I'm going to look that the implied volatility was higher, and the assumption there is if implied volatility is moving higher, then premiums are getting bid up. So there's more buyers of options than sellers. Okay, so IV up. So we should see this, that implied volatility is higher. Now, we want to see where there's a lot of upside call activity. So I'm going to move to this tab over here. And this tab breaks down the activity by percentage calls, percentage puts, and by out of the money, at the money, and in the money. So depending where the spot price is are the calls that are being traded above the spot, that's out of the money. Are the calls being traded right near the spot price where the stock price is, that's at the money. In the money is that the call option is already in the money or below, where it's already has intrinsic value. It's below where the spot price is. Also with the put, the opposite. Here it breaks it down by dollar notional, how much in dollar value were those options trade. So it aggregates all the calls, all the puts, out of the money, out the money, and converts it to actual dollar amount that was traded. So let's take a look at these filters. We're going to start with the calls, out of the money calls, and we want to say, let's take a look at calls that were out of the money calls represent at least 25% of the total volume traded. So I'm going to use this filter and say percentage of the out of the money calls represented 25% of, at least 25% or more of all the option volume in that stock. And let's look for call out of the money right here, notional, that it in aggregate, they had to be at least $200,000 worth of calls traded in aggregate in just out of the money. So here we go. So we narrowed it down to like, what, 7. So in EOG, right, 46% of all the volume yesterday was in out of the money calls, and the total dollar amount in out of the money calls was $256,000 worth. So we see that out of the money and at the money calls was 91% of all the trades, right? So I'm sorry. Yeah, it looks like that. So so most of those trades, right, were at the money and out of the money calls. Verizon, $1.3 million worth of out of the money calls traded yesterday. XLNX, $542,000 worth of upside calls. Goldman Sachs, $3 million. So we just looked at actually Goldman Sachs, $3 million worth of upside calls traded. Sienna, $400,000 worth of upside calls traded. Apple, $150 million worth of upside calls traded. And Eli Lilly, $875,000 worth of upside calls traded. So that's really quickly, upside call, where there's significant upside calls traded by notional. Does that make sense to everybody? These are the stocks: EOG, VZ, using the filters that I said. $200,000 at least in notional and upside calls. So if everybody is okay with that, I'm gonna move on.
Move away, my friend.
Okay. So let's take a look at The next one, what I wanted to do was compare Apple. I'm going to go to the Apple screen. I'm going to take a look at the key ratios in Apple here. And this is something we're working on, but I'll just start kind of showing you guys prior to releasing it, because I'm still looking through the data and trying to validate, a lot of data here that we purchase and license, and then we have to kind of clean. So I'm going to do a comparative analysis of Apple, and I'm going to compare that to, let's say, Google. So why am I doing this? So before we do, a comparative, it's a way for you to make an analysis of, if you have two stocks that are similar, you could compare them and then try to see which one do you think on a relative basis is the better deal. So you probably do this every day, when you're shopping, going to the supermarket, or like, let's say you're looking for a car. So you're going to find two similar cars, and then you're going to compare the price of it, right? And the value you're getting for it, like, the features and so forth that are important to you. And you do a comparative analysis to see, like, well, on a relative basis, which one is a better deal. So that's the idea here. So I'm going to compare Apple to Google, of course, compare Apple to the QQQ, Apple to SPY. So let's just do Apple and Google, because, they're high-tech stocks, very similar in that perspective, very high market cap stocks. So let's just take a look at those first. So we see here, these are the valuation ratios. We have the profit ratios, so we could look at the profitability. We could also look at their growth, and we could take a look at where some of these metrics compare to their historical averages. Okay, so let's first take a look at their valuation ratios, and we see here that on a PE ratio, so what is the price you're paying above what the company actually earns in the last 12 quarters, right? So how much over are you paying? So here we see that Apple 36.72 versus Google 34.48. So on a relative basis, we're paying a little bit more for Apple than we are for Google. Same thing if we normalize it, the earnings per share, a little bit over for Apple than Google. Price versus sales. So that's basically, we're comparing how much price we're paying over the total sales. So earnings, of course, that's revenue minus your expenses. That's your earnings. That's PE. What about sales? Sometimes, we compare sales because sometimes companies don't earn money, right? They're just using it to grow. Like, Amazon might have a really big PE. So we'll compare how how much price they're paying over their revenue. So price versus sales, we see that right now, Apple a little bit higher, 7.84 versus Google, $6.55. Price versus book value, right? And that's one of the things with Warren Buffett was very big on book value, but price versus book value, we see Apple 28.65 versus Google 5.14. So on a valuation basis, this is relatively higher. Same thing, tangible book. I'm going to come down here, price versus cash. We'll get into this PEG ratio, but same thing with PEG ratio, which this is just basically taking the PE ratio, dividing it by the expected earnings, or what analysts are expecting the earnings to grow at. So even here, we see Apple 2.99 versus Google 1.79. Price to cash. So this is how much cash do they have on the book, right? So assuming they could take that cash and reinvest it and grow. So price to cash, Apple 22 times its 22 times the price over cash versus Google 8.82. Price to free cash flow here, you got Google 34.86 versus Apple 29.95. So far as I'm going through it, Apple seems a little bit more richly priced, right? Price to, this is earnings before interest, taxes, and depreciation. Okay, so this is just the net earnings. This is EBITDA. So what it's doing is saying, what are the earnings before you take out taxes, before you take out interest, before you take out depreciation? So Apple 25.03 versus Google 22.02, a little bit higher there. This is EBIT, so that's earnings before interest and taxes, almost the same. Google a little bit higher. Working capital, Apple 46.28, Google 10.1. So right now I'm just kind of slowly, before I get into the growth and the margins, I'm just saying, well, which one is more richly priced so far? To me, it looks like Apple is more richly priced than Google, so I have to start justifying it somewhere, right? Payback. So what this is saying is, if we assumed, Apple's earnings and they're going to grow at the expected rate, it will take 13.6 years to basically purchase the current stock. So you take your 13.6 years of accumulating earnings, expecting if it meets its expected growth rate, it will take 13.6 years to collect all those earnings to buy back what the stock price is today. With Google, 10.57. Is that making sense to people? That's the payback. Price to cash flow from operations, 26.84, 19.63. Enterprise value to EBITDA, 25.22, 19.4. So we could see, at least from this analysis really quickly, we see Apple's a little bit more richly priced than Google. So let's take a look at the other analytics. So here, what about their profit margins? So Apple looks like the profit margin's 38.2 versus Google 54.2. So that to me looks like Google actually has higher profit margins than Apple. EBITDA margin, Apple has 30.3, Google 29.1. Very, very close. Apple wins out a little bit there. EBIT margin 26.1 versus Google 21.4. Apple's a little bit better there. Net margin 21.4 versus Google 19. Apple a little bit better there, slightly better. Of course, we got effective tax rate. Apple has a little bit, the lower the better, right? Return on equity there, Apple actually did much better, 69% return on equity versus Google 15.8. Sales per employee, that's not that much. Pre-tax margin, Apple 25% versus Google 21. Apple did do a little bit better there. So some of these are justifying a little bit of a higher valuation, except this one here, gross margin, right? So that gross margin looks like a very wide spread to me. Operation margin 24.5 versus Google 19.8. Return on assets 18.3. Apple's better, 11.8. And then the cash return 30.6 versus 3.2. So here, just comparing so far, valuation, Apple's a little bit higher. A lot of the margins, they're very close. Their profit margins, except for the gross margin, looks like Google is has a much wider advantage, 54% on the gross margins. So those gross margins is consider it as your revenue minus your cost of goods to produce those goods. That's your gross profit, right? So that's before you take out, interest expenses and marketing and stuff like that. It's just like, how much did you sell this product for? How much does it cost you to produce this product? That's your gross profit. And you take your gross profit divided by your revenue, that's your gross margin, okay? So think of it this way. And this is one of the features that Tesla people are looking at, their gross margin, right? Because they haven't been profitable, but people are paying attention to that gross margin. So let's take a look at the growth really quickly and compare. So look, earnings per share, 3-year growth, Apple 12.7%, Google 20.9. That looks there. Google obviously beats them on a 3-year growth. Revenue growth, 5-year, Apple 7.3, Google 19.7. Google definitely beats them on that. 5-year Operation income growth, 4% in Apple, 16.9% in Google. Gross profit annual growth, 5-year average, 6.9 versus 17.4. Google beats on the growth. Capital expenditure, Google much higher on that. Net income growth, 6.9% in Apple, Google 19.4%. So at least from the historical growth rate, Google's looking like it's beating on those fronts. Let's take a look at the 5-year average margins, right? So gross margins in Apple, 5-year average, 38.8 versus Google 58.9. Gross margins look better in Google, and that's, similar to where they are now, except that maybe Google's a little bit lower recently than its 5-year average. Profit margins, 5-year average 21.8, Google 19.6. Return on investment capital, 5-year average. There, Apple does do much better, 24.7 versus Google 13.7. 24.7 versus Google 13.7. Return on assets, 5-year average, 16.2 in Apple versus Google 11.7. Apple does better on that. Return on equity, Apple blows it away there, 45.1%, Google 14.9%. And look at here's the P/E ratio. So you see Apple's 5-year P/E ratio, 17.7 versus current 36.72. Google 34.38, right where it is. So you see that Apple's P/E ratio was way below where it currently is and way below Google. So maybe just caught up, right, to Google. Take a look at those metrics. Obviously, some places Google's still doing better. Some places Apple's doing better. Certain things are similar, but you could take a look. These are the growth rates here. If you're taking a look, just what is valued on a relative basis, higher looks to me like Apple's a little bit more richly priced than Google. So really quick, we're running up against the bell. I'll let people go, but I just wanted to kind of go over those numbers really fast.
A lot of talk about a full webinar when this comes live, D.
Yep. Yeah. I'm going to get to that. I might have to do a couple webinars on this, but just wanted to introduce some of these numbers. And as we go forward, I'll do like a more deeper analysis and maybe like, maybe some conclusions.
Yeah.
But at least at this point, just wanted to start showing people, getting them familiar. And I don't think this is actually out yet completely because we are seeing like exceptions everywhere, and I'm trying to work through that, to deal with, things that are reported on the SEC level. Sometimes it's a little bit confusing because different companies have different names and nuances. So.
All right, we just missed the opening bell, D.
All right,
gotta get in front of our monitors. Thanks, everyone. Jake, some great points out there. Dr. Mike, thanks for joining us. Michael, thanks for joining us. All the chameleons out there, you have a great, safe trading day. Dima, great job. Thanks so much, buddy.
Thanks, everyone. Have a great day. Hope to see you guys tomorrow.